Hello everybody, it's me the Boss Hog. Today we're going to look at actually a new format for this video. Lots about earnings, very little about my trades this week, mainly because I did very little trading this week. Anyway, I appreciate some feedback. Let me give you my thoughts on these companies here, as well as a few more. Let's do it. Alright, so first of all though, before we get to the good stuff, just a very quick walkthrough of my performance this week. I think it's important that I remain transparent, so let's go through it nice and quickly. Honestly, you can see from the table there on the left, it was a week of two halves. Monday and Tuesday really red, Wednesday and especially Friday very green. So overall about up just over 1% for the week on my portfolio. And actually the nice thing about the Friday finish is that I'm up overall now back into green on my portfolio, so that feels great. I was very badly impacted by Russian holdings that I had, a couple of Russian miners, so I've been playing catch up for the last few months, and now still running behind the indexes very slightly, but at least now I'm back in the green, and again catching up those indexes all the time feels great. No capital added this week, broadly as expected. I'm still waiting for some money to come in, both from pet insurance, no idea where that's coming in, and remortgage money as well, which some of which is being used for stocks. That's now with my lawyers, so hopefully that will be completed next week. And what that means is, because I didn't put any money in over July, we are back on schedule. We had been running, 4 weeks ahead. Now we're back to on schedule. I plan to add some more money next week as well. No real trading, you can see there by the middle table. Honestly, I just reinvested some dividends I got, which we'll touch on in just a sec. Also, though, now my wife has started a new job at the private equity company, which means I have very restricted trading. Basically, without getting pre-clearance, it means I can only invest in ETFs. So actually, I'm going to start sort of walking through my rationale for buying ETFs. They'll be geographic, they'll be industry-wide, they might be some other things I haven't really decided yet. But I'll be adding some money next week and buying some funds, so that may or may not appeal to people. And last but not least, one dividend as expected for Micron. Pretty small. Micron isn't exactly a big dividend payer, but it went straight back into Micron. Pretty good month actually in terms of my dividends overall. Next month though is going to be very modest, only about 36 quid expected. However, there will then be a bit of a catch up in September of 540. So if I take those 2 months together, there's about 10% growth year on year, so that's great. But where I've kind of rejigged my portfolio between this year and last year, the months fall quite differently. So next month is going to be very modest on the dividends, unfortunately. Anyway, let's whiz through the rest because I'm sure everyone's very excited about earnings. So just Micron. Dividend went straight back into the company. Again, I am technically have to do this now on restricted trading. When I get the dividend, I am allowed to drip back into the company, but I can't invest it into single companies. So for example, I couldn't instead buy Apple or Microsoft with this dividend. What I could do, in fairness, is instead of putting it into Micron, I could put it into an ETF. But honestly, I'm very happy buying Micron at these levels. I am fractionally down on my Micron position at the moment, but only by about 1%. And again, I'm really happy with my average here in the very low 60s. So we will see how that shakes out in due course. There were no sales this week, as you've already seen. So we're going to start walking through how my portfolio performed in detail, but I'm also going to be touching on earnings as we go. So let's do that now. All right, so in my portfolio performance, everything highlighted green here I'd like to talk about for a bit. In terms of the E and D there and the dates, that's the earnings and the dividend updates when they're due. For August now, so these have been updated. I was previously showing ex-divi dates, but it just made it look a bit messy, so I decided just to show those two and where I'm getting them from. So let's start with Unilever, Huntington Bank shares and Games Workshop. Now I'm going to go into detail on this video into Unilever and Games Workshop. You'll notice that I don't own any Unilever, and I thought it'd be an interesting challenge because they published results this week, and I describe myself as basically a permanent Unilever bear. I think it's a bit of a basket case of a company. It's so ridiculous, it's literally suing itself, and if you think I'm exaggerating, I'm really not. Underperformed for many years. However, they put out results this week that the market were broadly supportive of, and I want to have a little look just to see whether I'm a bit behind the times and maybe there's some progress has been made, and whether I would now personally put money into this if I could. Huntington Bank shares is a regional bank in the US, primarily in Ohio, but actually in quite a few states now as well. I'm going to do this a little bit differently. I'm actually going to give them a dedicated video, and again, I'd appreciate feedback on what you prefer, sort of like mid-level views in a weekly video, or sort of just a single video, 15 to 20 minutes worth talking about specifically Huntington Bank shares. So there'll be a video over the next couple of days specifically for HBAN. I've already been on their earnings calls, made notes, etc. It's purely for my own interest and way of formatting it. As a tease, I think they produced pretty good results, and I was pleased in a number of areas. So I was pretty happy with their update and the general direction of travel there. And last but not least, Games Workshop. I've done dedicated videos on Games Workshop before. They had their year-end results, broadly in line with expectations, I would say. But again, we're going to delve into that because there are some interesting call-outs there. Next up, though, before we go into those details, I want to talk about a few more. So Kainos here, you'll see this is my third line down on this, this data. They really did quite well because they are the only UK listed Workday partner. So as in, the American WDAY Workday, they basically, a significant part of their business is sort of project managing, delivering, customizing that solution, as well as a few other bits, sort of bespoke software development, etc. So because Workday put out pretty good numbers, Kainos was really seen as a beneficiary of that. And to me, actually, I think Workday is still a bit of a spicy investment at the moment, and it doesn't really align with my investment goals in terms of like small, already very profitable companies. Kainos for me is an excellent play if you're kind of interested in Workday, if you'd like the tool, which I personally do. I used it in my last job. Kainos is really very profitable already, very small, has, in my opinion, really high quality, and I actually think it will be in the FTSE 100 by about 2025, something like that, on its current growth. Very excited about it, but I just wanted to call it out because it did have a very good week. I have what I would class as a mid-sized position in it, about 2% of my portfolio. I'm very happy with that sizing, honestly, and that for me now is very green, so that felt pretty good. Not any earnings or anything like that, but I just wanted to put it out there for the reason for the jump. I do just want to group big tech, but actually they're quite different in a number of ways. So I'll start with who I thought was the worst performer, especially when we got to see other results, which was Meta. I mean, it's seeming like they're having difficulty monetizing is how I would describe Meta. I didn't think it was a complete write-off because, there were some positive improvements on sort of average users per month, unique users per month. Those kind of metrics were actually positive, kind of mid-single figures. So that was good. But, this is their first ever quarter of revenue reduction, and it didn't read great. I mean, there's no two ways about it. I don't have a massive share in Meta, as you can see there. That's about 0.6% of my portfolio, something like that. And it was a bit of a speculative play. Not even speculative, more like a value play. And I would still argue, actually, that, Facebook is still pretty profitable. You still get a decent PE in there. It does still throw off a lot of cash, but, like there are some concerns about how we monetize what they're working on at the moment in terms of the metaverse. There are still some challenges regarding sort of data sharing, advertising, that kind of stuff. And so I think Meta was, if you want to class it as big tech, which is questionable, but it's certainly bigger tech, I think it was quite disappointing, and honestly. What wasn't disappointing was Microsoft. I still maintain that this is the highest quality, big company that you can get. It's certainly not cheap, but I think it absolutely justifies its multiple. Basically just firing. I think especially impressive was Azure, which is growing at like 47%. I guess disappointingly was PC sales, but I wasn't surprised about that. I'd been on semiconductor conversations and earnings calls before, where there's obviously been a slowdown in that market. And also I would say on the gaming was a little bit disappointing to see that drop back as much as it did. Kind of a combination of game pipeline as well as sort of disposable income for that target market impacted there. But broadly speaking, I mean, Microsoft is so diverse and so spread and really just growing really well. I think it's very impressive, and for me, yeah, almost no surprises. You almost expect it from Microsoft at this stage, but still, I think it to be growing at sort of the speed that they are, considering the size that they are, truly impressive. Something else that actually really surprised me was Apple. So for me, like, I don't use Apple products. I'm not especially like evangelical about it or anything. It's just people obviously are, and to me, you almost want to see it as like a consumer company in a way rather than a tech company. Obviously it is, but for me what was really impressive was the fact that their hardware sales really held up. I was honestly amazed. Really positive. I thought they'd be impacted from everything from sort of Chinese lockdowns, from freight costs, margin pressures, etc., but I just didn't see it. So that was a big shock. Also, as well, what continues to go a bit under the radar, in my opinion, is the fact that their services group of revenue is really growing quite nicely as well. And to me, like, Apple is building an ecosystem where they're basically going to move toward a subscription model. It's going to sort of be like your phone contracts, but they're going to include lots of other things in it, and have people paying £50 to £100 a month for X, Y, and Z services. And that's really starting to pick up, and will create that kind of brand loyalty even more than they already have. So I think Apple was one of those, like, just, I mean, they turned up. I think I was surprised by Apple. Like, Apple and Microsoft both really impressive. But I think Apple was a surprise to me, whereas Microsoft wasn't. So there was that. What was also relatively surprising was Amazon. Obviously here the revenue side of it was especially impressive. If I'm honest, I thought the market overreacted a little bit. They were solid results, pleasing, all the rest of it. But AWS didn't hold up as well as Azure. Also as well, like, they hired a lot of people, and it's not really clear what they're doing or etc. So I'm kind of curious what's happening behind the scenes at Amazon. I'm kind of a little bit nervous about earnings. Obviously, they had the Rivian write-down, which is going to impact, and without that, they would have had like a $2 billion profit. But still, wafer thin when you look at the sort of revenue size. And I know that's Amazon's business model, right? They're constantly reinvesting. We can forgive Rivian. I mean, in the scheme of things, it's not even that much money for a company of this size. It's silly and a distraction, and it makes the numbers a little bit harder to read. So I think the EPS without the Rivian would have been like 18 cents. So not huge for the quarter, considering the price of the shares, right? You're still looking at a really hefty PE by traditional measures. But yeah, I mean, it was good. I mean, I have a mid-sized or smallish position here in Amazon, about 1% of my portfolio, and it's now very green. I'm up like 25% on my position after that. But I thought it was actually a little bit overdone. The reaction, the after hours jump of sort of north of 10%, which is huge for a company of Amazon's size, right? I think Amazon's results were perfectly okay. But I am a bit concerned that they're sort of starting to lose out on the cloud space, and that their margins are being eaten into. That may well be the reason why they're almost being forced to put up Prime membership for the first time in many years, and obviously that's a way to mitigate. So I would never bet against Amazon. I absolutely wouldn't sell. But I think the reaction was a little bit overdone, if I'm being perfectly honest. And last but not least was Google. And here I thought the opposite, actually. Like, I thought the reaction was a little bit harsh. I thought considering like what we saw from Facebook, if you were following me last week, you saw that I ditched S4 Capital, sort of a UK listed advertising company. Like, considering the relative carnage and the fact that advertising is like a leading indicator to a poorer economy, I think Google's numbers were perfectly acceptable. Yes, there's clearly some pressure there, but I think it was okay. So yeah, I thought it was harsh that the after hours saw like a 3% fall. To me, it was broadly speaking in line with my expectations. So I just wanted to kind of round out how I saw the big tech. Other channels have covered each one of these in a lot more detail. I just wanted to kind of do a 1 to 2 minute walkthrough of how I viewed the big tech that I own, basically. Next up was T Rowe. So T Rowe's financials are pretty thick and difficult to sort of get your head around in many places. They're just very dense. Like, it's not like rocket science or anything, right? If you're used to reading numbers. I would describe them though as expectedly rough. I mean, you're looking at asset under management falls of 20% or so. However, you compare that to the broader market and it's more or less in line. Also, what I would point out is their costs, and especially their cost of sales, were basically in line with their fall in their revenue. So, like things like commission and servicing costs were all down sort of 20%, give or take, as well. So, and I think actually the market reaction was fair for T Rowe. Like, it hardly moved because I think like there was no shocks in it. Like, T Rowe still has a lot of cash on the balance sheet. It's still very well capitalized. I think it's very well respected still paying out a relatively modest percentage of its earnings, and it is still earning. So for me, like, this is still a perfectly reasonable entry or an opportunity to buy T Rowe shares. You just have to accept that you're going to get a reasonable amount of volatility. And for me, who hasn't historically have had many ETFs, it's actually a very useful play on sort of the American economy, the stock market, the wider sort of economic situation. So for me, having T Rowe is a very useful sort of almost leverage play on that, because they're going to be reacting equally, if not more, than the underlying market movements. I would also say that within like lots of detail was a couple of like rays of light. I think most impressive for me was the fact that their assets under management did actually go up specifically for their retirement products, which I thought was very good. Specifically, that's relating to inflows. So, you know, like there was a net inflow position in that, obviously, because then the pensions are exposed to the stock market. They're going to be impacted by that. But in terms of their net inflow and outflow, that was positive specifically for retirement products. So again, people are still sort of happy to go with T Rowe, and T Rowe is still winning the business there as well. But obviously it's not going to be pretty for T Rowe until the wider sort of sentiment improves. And for me, I'm perfectly okay with that. And although it doesn't make for great reading, I thought it was okay, and again in line with what I was expecting, and I think the market as well was expecting. I also want to mention Phoenix. So this is a UK insurance company for anyone who is American and hasn't heard of them. Very large though by UK standards. And I think what was worth calling out here was that they had a very good week, up 5%. Now they do have a fairly chunky dividend coming up as well, but this is another good week after another good week. And basically a Saudi investment fund has taken what's now a 4% stake, give or take. What was interesting is they've been building it since June, but in the UK, once you get to 3%, you basically have to declare that you have a major interest in that company. So, you know, they went above board with, I think, a 3.8% holding. Now, the Phoenix is almost entirely owned by institutions. It's like 90% owned by institutions. It's one of those companies that other insurance companies like to invest in, you know, pension funds, etc., because it's a very conservatively run business. It has historically done mainly closed life assurance books, bought them in a space which has very low margins, and basically got to scale where now they can outcompete basically anyone. So they are the go-to place for closed life assurance policies, but they've also been moving in the wealth management direction as well. So that's where they bought out Standard Life from Aberdeen. Again, these are well-known products if you are in the UK. And they're also been beefing up their reinsurance business as well, specifically by buying that part from Swiss Re. And by the way, both Aberdeen and Swiss Re, you know, had major stakes in Phoenix. Swiss Re have now exited. Aberdeen sold a little bit of their stake, going from 15 to 10%, but they reaffirmed the fact that they have no plans on selling below 10% because they want the seat on Phoenix's board. And there's also a Japanese company as well that has 15% stake in Phoenix that likewise sees it as a long-term strategic investment and enjoys the seat on the board as well. So, you know, these are institutions which have a long-term horizon. And for me, Phoenix is a great, a relatively large holding, honestly. I mean, I've got 6,000, so 6,500 almost. So it's you know, over 6% of my portfolio. And for me, it's a great 8% dividend play. And I still think even after this run up, it's still about 10% undervalued. So for me, it's looking good. And I think it was just newsworthy this week for a company that doesn't tend to move too much. So, yeah, hopefully that was interesting. I want to have a look at, like I say, Unilever and Games Workshop in a bit more detail now. So let's move on to that. All right, so Games Workshop. So I've done videos on these beforehand. I have a relatively large position. This is the top 3 holding for me. And I have done, like I say, dedicated videos. There weren't huge surprises in this in terms of the overall picture, but and that's mainly because, you know, about 2 months ago they put out a trading update more or less affirming that. But there are some interesting things, both in terms of exactly how the revenue falls and also some information within their earnings pack. So I have actually legitimately read their entire report. So CEO statements, you know, mission statements, all that garbage. Although interestingly, I would say that the Games Workshop CEO, who I think is fantastic, has an unusually candid summary. It was very frank and actually a kind of enjoyable, very human read as far as these things go. And, you know, I've pulled out a couple of things that he said and interpreted, etc. So just a bit of background there. Very large holding for me, this, and you'll see my thoughts on the earnings any second now. So first of all, let's talk about EPS. It's up modestly, I would say, plus 5%. This is on a stock that's seen a significant share price fall over the last year, as you know, there's basically been worries about numerous things to do with scaling, logistics, so both freight costs and warehousing costs. basically rubbish community relations with their customers, and also ever persistent concerns about 3D printing undermining their business case. What that's led to, though, is kind of an opportunity where, this is a company that's historically traded on a P ratio of 30, or at least for the last 5 years when it's really been firing. But actually over the last year, you're now looking at a current PE of just over 18, or 18 and a half. And a significant fall basically as a result of that. So revenue did climb by 7.5%. I would say that's on relatively tough comparables. Another reason why this share price has had a difficult year is because it was assumed, and probably truly, that Games Workshop really benefited from lockdown. Essentially, there was a bunch of nerds stuck in basements that had nothing better to do other than paint miniatures, read up on law, and basically, engage in the hobby. And the assumption was that would stop when people, exited lockdown. I'm not really convinced by that argument and never have been, but again, that's part of that reason as well. But it does mean that a lot of the comparables are really tough. Even things like their online earnings, which I haven't separated out here, but in terms of their online earnings, it was basically flat year on year, and they were actually really happy with that because, again, like last year, most of their shops weren't open, whereas this year most of them are, and they see their shops as incredibly important avenues into the hobby, right? It's where people meet up, they do competitions, they share expertise and thoughts. And actually, like, if you look at what Games Workshop pay shop workers, it's often like double what you would expect other shop workers to get, in kind of supermarkets and stuff, just because they're expected in many cases to run the store by themselves, and they're expected to be real experts and advocates for the brand. So a very different business model. And again, in Games Workshop, it was interesting. Like, they didn't furlough any of their staff; they kept them fully employed, and they basically just instructed them to, do more painting, read up, etc. So a very different approach to what many retailers took during lockdown and everything else. So that was pretty interesting. Where there was a huge jump was in the licensing, and to me it's been really pleasing over the last couple of years. The Games Workshop sort of saw licensing almost like as a distraction and something they weren't too interested in, and over the last sort of 3 to 4 half-year reports, we've really seen them got more and more keen on the idea of licensing. This is a growth of 72%. Now, this is a little bit difficult to really truly believe that number, because what was happening beforehand is that they were getting royalties from some of their board games that were then feeding into their core revenue. And one of the changes that they made is they've now moved all royalties into licensing, and unfortunately they haven't provided that breakdown, so I don't know what the true growth in like-for-like licensing is, but all that will mean basically is that their core revenue is also slightly underrepresented, because they presumably pulled some revenue out of there and put it into licensing. So I really wish they'd given us a like-for-like comparison, just to make that clear. I'm 99% sure, having read the whole report, that it wasn't there. Feel free to correct me if anyone does have that breakdown. I'll happily appreciate that knowledge. But you can see here now, not just in the numbers, which are up 72% on licensing, but when you read it, they're very clear on IP being one of their 5 strategic pillars. They're also really keen on sort of working specifically on video game content. They're actively looking for more partners. They've got a bunch of stuff that's either just come out or is already in the work that's being well received and people are very excited about. And for me, licensing is verging on 100% bottom line win. So that to me is a huge opportunity to continue to really rebuild their margins that have been under pressure. One of the nice things about Games Workshop as a British investor is that most British listed companies don't pay quarterly dividends. They pay what's called a full and an interim, so twice a year, and oftentimes they're not even the same amount, right? So they'll be like 1 quarter and 3 quarters, or 1/3 and 2/3, and it's a little bit annoying. However, here it's like they just pay quarterly, which I think is nice. One of the other nice things that they did in this report is that they finally defined what they meant by truly surplus capital. So in the past, when they were talking about dividends, they've never wanted to be a dividend growth company. That's not how they see themselves. They basically always spoke about truly surplus capital. We'll pay dividends as and when we feel like it. We don't care about trends. We don't care about how long we've been paying dividends for. You're going to get it when we have truly surplus capital. And no one's really ever known what that meant. However, they've now defined it. And actually, it's, I would say, a very low barrier. Like, if they're really sure about this wording, this is verbatim, right, taken from their report, it's anything that's basically it's surplus if they have more than 3 months working capital as well as 6-month tax payments. But that's not very much. Like, I guess because they are reporting quarterly and doing dividends quarterly, it allows them to operate at that kind of consistency. But this is a company that's like throwing off cash. And I now think that this is going to turn into a seriously good reinvestment drip dividend payer. They're already verging on 4%. Now, you might look at the payout ratio and be a bit concerned regarding the 70%, but part of this is to do when they reported and when they paid the dividend. Like, really, you want to sort of blend these years together, and you get a figure in the high 50s. So just to bear that in mind, it kind of looks like there's been a huge increase in the payout ratio, but that's not really what's happening. They actually sort of declared the same dividend in both years, but the payments fell differently. So just bear that in mind as well. Now, there has been some pressure on margins, but this is all really relative. So first of all, gross margin fell from 73 to 67%, and net margin fell from 39 to 38%. I mean, this is an incredibly efficient, profitable business that, like, you know, these margins are better than you'll find in most tech. You know, like, these are incredible, truly incredible margins. You know, their revenue is 414 million, their earnings are 156 million. I mean, this is a really profitable company. However, there are still growing problems here, right? So this is a company that's in the process of expanding relatively rapidly. And that's been happening for the last 5 years now or so, but really over the last couple of years, they've tried to expand. They obviously ran into lockdowns and everything else, but they also had challenges sort of building warehouses, so they were then having to rely on more freight. Their you know, IT systems and their like customer portal where you could order stuff from wasn't really very good because they were so used to selling in store, so they had to put money into that as well. And evidently, you know, there's been a lot of pressure on the growth of their finance systems, CRM systems, etc., because again, they just weren't really built with the model over the last 2 years in mind. So what that's meant basically is sort of negative impacts on inventory here for 10.6 million. Freight, by the way, I've grouped freight and carriage into one, but 12.6 million for those grouped. And also they've hired more staff and they've been paying them more than they originally planned. So these, you know, when you actually add these together, you're looking at a 25 million pound hit. So of these, obviously, if we didn't have these and everything was working perfectly and in line with budget, you know, you can basically put that on top of the earnings and you get 180. So suddenly, you know, their net margins are actually, I think next year or even next half year, their net margins will be back above 40 where they were, you know, 18 months ago. And likewise now, you know, their warehouses are up and running. Their web pages have got up and running and significantly better. They do still have some challenges IT-wise, which we'll touch on in just a second. But again, to me, this is a company that was surprised, not entirely of its own fault or, you know, its own silliness. I think, you know, again, their whole business model was sales bricks rather than clicks. And they weren't really ready for that. And I think it's sort of credit to them that they were able to pivot. So fine. The one thing I would say is that 6 months ago they were talking about having an IT strategy review. I sort of called that out, that I think this was a company that's basically that project seemed like it was doomed. I've been in large companies before where projects are doomed, and that was the impression that I got. Unsurprisingly, they've now appointed a head of IT and they've paused their ERP upgrade to focus elsewhere. From their perspective, they were brutally, I would say, honest about the fact that it wasn't going well, that they saw it almost like as a money pit. I'm using my own words here, but again, you can read the report, and that's effectively what we're looking at. You know, they talk about better opportunities to not waste money elsewhere, and they list things like warehouses, Warhammer Plus, the web, as in ordering, etc. What's still disappointing for me is we don't really know how much of this revenue is being driven from Warhammer Plus. When this service launched, it was very much ridiculed. There are now some good things on there, some much better approaches in terms of lore videos, some like a genuinely good animation. I call out the Exodite series. You know, and fans are being enlisted as well, as in very good content creators are basically being hired by Games Workshop instead of like being sued by them. So there is potentially some improvement also in their community relationships, which they do call out. But first of all, I would have liked to have seen the revenue from Warhammer Plus and the growth and what that looks like. I think they should be more transparent with that. Again, it's weird for me that they're not being, because it must either be truly terrible or actually much better than we think, because they've been so honest elsewhere in their report. So just something to call out there and be aware of. What I'd also say is, as far as I can tell, you know, and I did quite a lot of research into this, the community engagement's got a lot better. They've been hiring people. I think for me, one of the big call outs was that they're launching this new some new material in terms of their lore, and they invited 20 content creators from YouTube to basically host events, host like a battle scene at Warhammer World. So their HQ, you know, they could record it, they could post it on their own channels. So, you know, like talk about the boxes, talk about the new paints, etc., etc. It's a much more collaborative way of working with the community. And that to me is like where they should be going, right? These are advocates for your brand. You should be engaging with them and letting them monetize and get more excited about working with you, right? So that to me, there's been some progress on that. To summarize then, I continue to personally believe that Games Workshop is a fantastic investment. I think the bear case has been overdone, not only what I've already touched on regarding the community relationships. I think 3D printing is also significantly overdone as a risk for reasons I spoke about in my last video. But the long and short of it is these are genuine fans. They want to have real deal. It's premium and better. And although people talk about it as plastic crack because, you know, it's so addictive and it's so much money, actually there is a sort of camaraderie and an acceptance that this is an expensive hobby. And, you know, if you want to be serious about it, you want that kind of that coolness, for want of a better word, I can't think of a better way, that coolness of saying, you know, yeah, I've got the real deal. Like, I am passionate about this hobby. I do care about it. And I think, like, again, the rise of 3D printing for unhappy people, this is like a minority of people who make a lot of noise. There are still some things I think Games Workshop could do in terms of like discontinued models. I'm not sure why they're not at least working with a partner, you know, to basically have licensed discontinued models. People still want them, so why not kind of take some money instead of letting Joe Blogs take everything, right, from stuff that you're no longer willing to support. But again, I think broadly speaking here, the bear cases are overdone. The lore is fantastic, as in LORE, right? The content, I think there's a really great storyline going on at the moment. People are very excited about it, basically. So I think, yeah, bear case is overdone in my opinion. I also think that whilst not completely over the challenges of scaling, they're almost there, right? They've got their warehouses, they've got their freight, they've expanded their factory. They actually got a new factory specifically for paints and have basically redeployed space in their existing factories for molding, so to produce more. They've hired more people, and again, you know, when you enter new territories, when you do new things, you sort of end up becoming less efficient as you hire. And what I'm expecting to see is good growth from places like America, from Australia, more from Europe, and actually some excitement from Asia as well. So that's sort of what I'm expecting to see over the next sort of 1 to 2 years. So for me, in terms of trying to put a number on this, so I still think that this company deserves a multiple of sort of 25 to 30, maybe not quite the 30 of last year, but actually pretty close. Again, like there are still some stuff that they've got to overcome. I think freight's going to have pressure. They deal with like oils and plastics, right? They're impacted by the price of oil and things like that as well. So maybe, you know, like whereas beforehand I was on a 30 PE and sort of saying £120 a share, I have reduced that slightly. And here what I've done is taken a 7% EPS growth for next year and a 27.5 multiple, put them together and basically done a forward PE on that basis of 27.5, and that gave me a share price of 112, which again looks like it's extremely undervalued considering this is in the mid 70s. And again, I just feel very confident about it. I think like if you can look past the noise and realize that, yeah, okay, there is a bit of pressure on the numbers here. Yes, they've made some missteps, some self-inflicted, some a surprise. But actually these numbers are still really incredible. And, you know, to me, there's still a great business here that's only going to grow from here, basically. So very confident about Games Workshop. Not too many surprises in the numbers. Continues to move in the right direction for me. And yeah, I continue to remain very bullish about Games Workshop as an investment. So yeah, without further ado, let's look at Unilever. So again here, I want to be clear that I'm coming from a bearish position. I think I have been clear about that, but just to reiterate it. But I also think that I am open-minded, honest enough to reflect. I think everything that I've had in the past has been true. But actually, maybe now there is a business case here in terms of Unilever, you know, that's sensible, and maybe it's a buy. So I want to have a look at this and etc. Now, what I also want to say is Unilever has one of the best, probably the best, investor relations page I've seen, right? And by that I mean I've basically just been able to cherry pick data and graphs from their own. Considering the size and the complexity of this business, I actually had a very enjoyable 40-page read through easy to digest graphs that were incredibly detailed and useful and really gave me a great understanding of the business. So I don't know whether they have a really great ERP system, and maybe Games Workshop needs to talk to whoever did that for them, or maybe they've just got like an army of analysts who are, you know, sitting in Excel all day. I'm not sure, but what I will say is it's extremely clear to me as an analyst that this is a business that kind of knows itself. And to be fair, even in my more bearish days of yesteryear, this always seemed like a company that had kind of recognized the right strategic aims, but hadn't been able to execute on them. And, you know, I think as we're going to see, there's still some difficulty with that, but there are some signs that they are starting to progress. So without all that out of the way, what I will say here is that there was some good revenue growth. So again, I really love these waterfalls. I use them at work myself. This here is a revenue waterfall, effectively looking at last year and this year. Now we do have to deal with multiple currencies here. So I'm using their currencies, which are mostly reported in euros. But when I do my analysis, I've converted it into pounds because I'm mostly dealing myself with the pound ticker. But this is a company that's still listed in the Netherlands. It's also got an ADR in America on the UL there. So bear with me a little bit on the on that. And obviously some of these ratios will be impacted by FX. But I took the FX literally last night, so Friday night. So it can't be more accurate than I've got it currently, at least at this moment in time. So all that aside, what this graph is really showing here is that their underlying sales growth, so USG, has gone up 8.1%. What's interesting, and you can see it from both the graph and also their wordings, is that it's driven by price. And actually what you're seeing is the volumes have decreased, you know, 1.5%, but then their pricing has increased by 9.8%. And what that does is that then evens out to 8.1%. There is also here a sort of acquisitions and disposals, but to be honest with you, in the scheme of things, it's relatively modest. They got rid of a tea business. They bought a health business. It's like, okay, they've still got lots of brands and businesses and everything else. And then also, you know, they then put the currency impact as well. So first of all, I think it's worth bearing in mind that although there is a 14.9% year-on-year growth, which is really positive, right, undoubtedly, it is definitely supported by a fair chunk, almost a third, well, about a third actually, of that is favourable FX movements, right? So definitely worth bearing in mind. But in fairness, again, this is super clearly called out, and that's great. Also, one of the reasons why I have been so negative about this is that they have 400 brands across 190 countries, right? And the way that they've run their brands historically was that they gave them incredible power, but this ended up in a few weird things. So like I say, at the moment, Ben & Jerry's in Israel is suing Unilever, their parent company, so that's messy, political. Oh my god, like why as a business do you want to be involved in, you know, I mean, an intractable geopolitical situation? I have no idea, and to me that's ridiculous that a part of your business is suing you. That's just difficult to believe. In the UK, and I'm sure in other places, the country's come under pressure. Sorry, the company has come under pressure because, you know, you have like Lynx, or I think it's called Axe in most places, which, you know, is all about men feeling good and feeling sexy. And then you've got like Dove soap, which is all about like women just loving themselves for who they are, right? And it's like almost like the company's like schizophrenic. It looks very non-genuine when it's sending out conflicting messages, right? Do you think that all women should love themselves? In which case then, like, why is your Lynx advert like got hundreds of beautiful sexy women running at a very average man who's just used your product, right? It's like, I know that that's how they sell those products, but this is kind of one of those negatives about the fact that everyone knows that you're one brand, really, you know, certainly the media who might want to run a hit piece on you. So then why are you so keen on having everything so separated out? And one of the nice surprises in this, they teased about this 6 months ago, they've now delivered it, basically it's gone live, is that they are reorganizing. So their business groups now are 5 business groups, which to me make a lot of sense. They also credited this with basically delivering the upside in their pricing. They basically said that because now these businesses are run kind of collectively but separately, so 5 separate businesses, they're going to have 5 separate strategies. You know, that they were basically able to be at a good level where they weren't like so disparate that they couldn't coordinate, but they were close enough to make sort of smart what's known as variance analysis, right? Like you can put your price up, but then what does that do to your volume, and vice versa. And here actually, you know, the price went up and the volume did go down in most places, but still that was an absolutely right decision to make because it meant overall you made 8% more on your sales. So that I think is promising and moving in the right direction. And it was interesting that the CEO called this out as the reason why they were able to perform as well as they did. I would highlight the net debt increased by 2 billion. It's already north of 30. And what was most concerning for me is basically they're using debt to do buybacks, which to me I never really like to see. It's like I don't really like to see dividends either, right? Like you want to be using your debt. Like there's nothing wrong with debt in my opinion. It's just if you're going to take out debt, it's got to be for a value accretive reason. Now, maybe you can argue that buybacks are, right? And to be fair, if you truly believe that the share price is underpriced and there's no opportunities elsewhere, then great. But this is a company who, almost massively overpaid for GlaxoSmithKline's healthcare division, right? If you look at what the market value is and what they are willing to give for it. So I'm not convinced really that Unilever fully understands debt and then their investment case and everything else. So I mean it would have been up even more, but they had 1 billion of cash flow that kind of offset it. So I'm a little bit concerned by the debt. It's not huge in the scheme of things, right? Like they're making many billions, so but it's also not trivial either, right? This the debt to EBITDA is really high. And this isn't exactly a high growth company, so that to me I think they're moving in the wrong direction here for me personally, but okay, I think that's worth calling out though. More nice graphs from them, but I want to talk about earnings a bit more as well. So earnings are definitely under pressure. Again, credit to them, they're very transparent. They're calling out the fact that in H1 they had inflation headwinds of 2 billion euros. Now we're looking at 2.6 billion in H2. They said that H2 is always more expensive for them because of their sales mix and everything else, but they are actively working as hard as they can to minimize that, so take that how you will. What I will call out here is that there is a significant reduction in the profitability of the business. That's probably to be expected if I'm honest with you. But what you can see here is that the underlying EPS is being really pressured. That's a combination of sort of a change in their tax rate. Actually, it rose from 21% to 24%. Again, they labeled that primarily for the sales mix differences. So okay, that is offset by the share buybacks there, the SBB that you can see in the graph on the top right, and that had an impact. And what you can kind of see is that the current underlying EPS did go up by 1%, but once you strip out currency, you can see there actually a fairly substantial reduction in EPS. Like I'm not really of the opinion yet that the business has turned around a corner at all. Their gross margins are under a lot of pressure. Their EPS is under pressure as well for various reasons that you can see there. So I don't really see a sort of a step change just yet. However, let's try and be fair here. There are definitely signs, and I think this was fair. The CEO called it out, but I completely agree with it, that the simplification of the business is starting to work. I think the revenue change is really significant for a business of this size. I think the EPS, even with the caveat, right? And this is like a double-edged sword as well, because it does mean that, costs are different as well as sales. So I don't want to downplay it at all, but that is definitely something to note. But also something to note here is that the simplification, the fact, again, taking them at their word, that the financial performance has been helped by that. I am looking forward to the promised strategic plan for each one of these areas, which is due later this year, I think he said. So that would be interesting to see like how much they allow these 5 divisions to diverge. So there are some early signs. I think that's fair. Also for me, like it's long been the case that Unilever is all about the growth in India and China for the really sexy stuff. China is still impacted by lockdowns, but India for me was actually one of the real standouts. Their performance year on year was plus 19.5%. And their underlying sales growth there was hugely positive for both volume and price increases. So it was like, I think it was plus 6% volume, plus 13% for price increases. So that to me is really positive. And that story's been going on for ages, right? And I haven't really been convinced, and I guess neither has the market, which is why the share price moved flat for the last 5 years at best. So the buybacks, the 3 billion, that's 25% complete, so they've got 2.25 billion to go. They do pay a relatively good dividend, I would say, although nothing special by UK standards. I know to Americans 3.6 dividend is like best thing ever, but I can pick you Phoenix, for example, that's 8%, and I would argue is a much better business than this. And there's tons of other insurance companies, etc., that would give you better and aren't even cyclical. And then if you wanted some really, even greater margins for your dividend, You could go for the likes of mining, those kind of more cyclical stocks, but you could pick quite a few UK ones. So I don't consider 3.6 amazing. It's perfectly fair, but it's nothing amazing. And I would also say that the payout ratio for Unilever is pretty high. I don't really like to see this above about 60%. I get that this is a mature business, but again, this is meant to be a mature business that kind of is revamping itself, that has opportunities in sort of emerging markets. So that to me seems a little high. I'd like to see that come down a little bit, to be honest with you. And again, this would always be my concern with these kind of companies, that yes, they have potential, they have scale, they have that defensive reliability. But again, for me, because Unilever has always had these kind of growth problems or execution problems, maybe that's more accurate, I've never really trusted that there's good dividend yield and the buybacks are really being supported by an improvement in business. And I guess maybe that's why I can't really get away from the debt increasing in order to pay for the buybacks, right? Like, that to me is not a good sign of a business. You should be using your earnings to do buybacks. So that to me is not great. So what this means overall is EPS here of about 225. All right, I'm back into pounds now because I want to talk about stock price of ticker symbol ULVR. So the conversion here, I got 225 for the year. So these are fine, I guess, projected 6 months into the future. By the way, this worked out £1.12, and then I basically doubled it just to keep it simple. So currently, if you look at the share price, which is just north of £40, you get a P of 17.8, which to me, I think is still quite pricey. Again, because I suppose part of the argument might be that this is defensive stock and that's it's a volatile market, but I don't really rate the defensiveness of this company. I don't think it's shown me that it's defensive in the same way that, you know, an electricity company might be, or a water company, or a pipeline company, as in gas or oil, etc. Right? I don't really have that confidence because they're just not reliably growing their revenue and earnings. So I can see some potential improvement here in terms of their revenue growth, but again, earnings to me hasn't yet delivered. So I'm sort of going to be watching them. And overall, what this means is that for me, I can't justify more than a 15 PE here. And I originally wanted to make this 12, but I thought that was a bit harsh. So, you know, if I take the PE that I'd be willing to accept for a mature, slow growing at best business that is kind of trying to improve itself, maybe has some progress of that, I think anything about 34 quid here, just you're looking at not a tremendous return. And I think there's just too much risk. So for me, I would absolutely consider buying Unilever for 34 quid. I have actually in the past owned Unilever in the 36s and then sold out at 42. So it's not like I'm completely against this company. I do think there's a point that most mature companies could become attractive. And for me, I guess that figure would be about £34. Unless, you know, again, the strategic review is amazing, or this revenue growth is able to, you know, continue and or translates into EPS growth, you know, but I think right now there's just too much uncertainty. So although I would no longer say that Unilever to me looks like a basket case, I'm not really ready to say yet that it's out of sort of A&E. It's still got lots to do, in my opinion, to make it a defensible investment, you know, defensive stock that I would put my money in, I mean by that. And yeah, I'm just not interested in it at the moment. So some progress, I think it's fair, but I still remain pretty bearish overall. So anyway, this video is really long already, so I'm always glad I'm going to have H-Band separately. Again, I appreciate the feedback. Good, bad, I don't mind. I'm trying to improve the channel and your viewing experience, so let me know. Anyway, thank you for sticking with me for the better part of an hour. I've been the Boss Hog. Good luck with your investing, and bye for now.